Good evening. This is Professor Mayer. I thank you very much for your attention and attendance this evening. We have what I think is going to be an interesting discussion related to the audit process. And in Chapter 5, we're focusing on business processes and risks, which is really the focus of internal auditing. And in Chapter 6, we're going to talk specifically about internal controls, so the internal control framework, which again is very important. Okay, so let's go ahead and get started and focus on a couple of things that, again, I believe are going to be very important. Okay, so let's just sort of take a step back and understand where we are in relationship to the CPA and what CPAs do versus what internal auditors do. Okay? So in the CPA exam, in some ways it's very similar to the CIA exam. And in fact, one of the things that we recommend students do after they've completed the CPA exam is that they go for a second certification. And the reason it's important to go for a second certification is because what this will do is this will enhance your profitability or your marketability out in the field. But at the same time, the fact is that you've got all this knowledge that is stored inside of you that you use to prepare for the CPA exam. And given the fact that the CIA is talking about the same thing, although from a different perspective, is it really does make sense to think about the CIA exam as a complementary exam related to the CPA. Okay? But let's just talk about it from the perspective of what a CPA does and an internal auditor. Okay? Now, very interestingly, if anyone has actually taken internal audit or external auditing yet, is one of the things that I think is quite fascinating is that the CPA actually can use the internal auditor for some of their work. Okay? Now, the CPA takes responsibility for this and verifies it, but the fact is that the CIA can, in fact, does many of the same things that a CPA does. Okay? Now, for the CPA to use the work of the CIA, the CPA verifies that the CIA is independent. Now, independence from the perspective of an internal auditor, a little bit different. We are working for the organization. However, our independence is based upon who we actually report to. And generally speaking, in a good internal audit department, what's taking place is that the auditor is reporting directly to the board of directors, to the audit committee, and it's the audit committee that actually approves the audit plan for the internal auditor. Even though the CIA works for the client, the CIA must be independent of what he or she audits for the client and does not have to be independent for what she or he does not audit. So what are we talking about here? Well, when the CIA completes an audit, when the internal, change the word CIA to internal auditor. So when the internal auditor works for a specific department as an auditor, there needs to be an independence there. And what we mean by this is that the auditor will not be writing policy. The auditor is only making ultimately recommendations that is in the hands of management to actually change. And the reason this is important is because the CIA needs to be independent. Now, the reality is that the CIA doesn't have to be independent for everything. In fact, the internal auditor may in fact work in a consulting role, and in this consulting role, the internal auditor is actually making recommendations, maybe even writing policies and procedures. But we want to make sure that if an auditor writes the policies and procedures, that's not the auditor that actually ultimately then tests the controls within that department. Okay, So the CPA walks a fine line between helping the client and being independent. CIA, same thing, is we are working with management. There's no question about that. We live with them. We are part of the same organization. But at the same time, our independence is driven by the fact that the auditor gets their responsibility and their role directly from the board of directors. In this last comment here, which I think is important, is that the CIA can help to reduce the audit fee from a couple different perspectives. We've already said that the auditor, the internal auditor, can in fact be used for some of the testing. But beyond that is the auditor actually assists in terms of developing this control framework within the organization and the monitoring within the organization. And as the external auditor determines the nature, timing, and extent of testing that they'll do, is they rely on their assessment of the risk of material misstatement. And there's no question but that a strong internal audit department actually lowers the risk of material misstatement, and through this lowering the risk of material misstatement actually does impact the amount of testing that's required by the external auditor. Okay, so that's, I think, is a very good framework related to Chapter 5. So Chapter 5 is we are talking about business processes and risks. So when we talk about risk, what we need to think about is what can go wrong. Now keep in mind that when we talk about risk, we're not talking about something that has gone wrong, only that could go wrong. Okay, so it's very important for us to understand that we're not saying something has gone bad. What we're saying is that something has the potential of going wrong or going bad. Okay, and we always talk about risks related to internal controls, and risk-related internal controls, there's no question but that there is a relationship, and we've talked about that relationship in the past. But what we're going to talk about tonight is in Chapter 5, we talk about the risks related to business processes, and in Chapter 6, we talk about the same issues, but we talk about it from an internal control perspective. Okay. Now, when we talk about business processes and risks, one of the very important things that we need to understand is that part of what management needs to do is an enterprise risk management process where management understands the risks. And we talk about risks really from a top-down approach. So the first thing that we really want to think about is our strategic risks. So we talk about strategy from the perspective of, are we actually doing the right things in the organization? And this is really high level. These are the kinds of decisions that are made by senior management in terms of, are we actually going the right direction? Have we assessed the environment appropriately? And this can be absolutely detrimental to an organization. So example, if we don't meet revenue objectives by a certain date, or we're not able to maintain a competitive advantage, we're going to fail. And frankly, it doesn't matter what things we do in terms of processes. If we don't have the right strategy, everything else is going to fail. So when we talk about risks, when we talk about this, we need to look at it from a top-down approach. Operational risks. Think about these things as the processes that support the strategy. So we need to break down our operations into very specific functions. And we think about these in terms of controls and processes. And again, we want to make sure that not only are we doing the right things, but we're doing these things well. So operational, are we doing the right things? And are we doing the right things well? Very, very important to understand that. And that's why we're talking about objectives related to operations. Is the objectives, or the strategic objectives of the organization, are not going to be met because these operations are not supporting. So again, strategy first, operations second. Now, embedded within these processes, we also need to understand financial statement risks. Financial statement risk is certainly something that the external auditor is assessing, that the financial statements are materially incorrect, are not according to GAAP, or not a fair representation of the results. And so we need to make sure that the financial statements are fairly presented, but we also need to make sure that these financial statements reflect what the organization is intending to do. So again, think about financial statement risk from two different perspectives. Are the financial statements correct? And number two is, are these financial statements showing that in fact we are meeting forecasts, that we are meeting the strategic objectives of the organization? Embedded in the financial statement risk is the issue related to how we're actually supporting the strategy. So the question related to the strategy is based upon this whole concept of our capital structure. So do we have the money on hand to follow the strategy? Are we borrowing money? Are we using equity? How are we actually supporting the strategy of the organization? And if we don't know this, well, it's going to be highly problematic. And when we look at our financial statements, we certainly want to use the financial statements as the basis for how we're actually assessing the organization. Finally, when we talk about compliance risk, we certainly think about compliance from GAAP, but we also want to make sure that we are following other compliance issues. So as an example, if we are a healthcare organization, we certainly want to follow the compliance rules related to Medicare and Medicaid billing. If we are manufacturing, we want to follow the guidance related to ISO 9000 or whatever standards that we're following. The idea being is that if we are not following the rules, there is in fact a risk. And not to go in too much detail, but certainly I recommend that you actually look at this, is the whole issue related to what's taking place with Volkswagen right now, and what's happened with them in regards to the compliance to rules and regulations related to emission controls, and how not following those rules has ramifications well beyond just the immediate financial statement numbers. Okay, so, and again, we're looking at this from the perspective of the internal auditor, okay? So the internal auditor is here to provide assurances. We're providing assurances in regards to our specific engagements, and our engagements are going to be compliance, going to be operational, we're going to be looking at the effectiveness and efficiency of operations, we're going to make recommendations related to internal controls, and when we're talking about what it is that we're doing, is we are focusing clearly on, are we doing the right things, and then are we actually doing these things well? And are we doing the right things, meaning do the things that these groups do support the overall strategy of the organization? Okay, so the risk assessment that the auditor does includes this planning, where we're actually looking at things from an enterprise perspective and making sure that our efforts actually are focusing on what's important in relationship to the organization. Okay, so in the planning, we determine the engagements, the objectives, and the scope. Okay, very important to understand that we clearly need to outline what the scope of the engagement is. And one of the hardest things in relationship to an internal audit is narrowing the scope in such a way that we can get in, do our testing, get out, and communicate the results without having what I call scope creep. In other words, we go in with one objective, and then in the middle of the audit we see something else, then we go that direction, then we'd see something else, we go another direction, and the audits tend to meander. And I've seen organizations that have issued 60, 70, 100-page audit reports that are basically meaningless, and the reason they're meaningless is because they've defined the scope in such an abstract way that it's very difficult to relate the results of the audit to something that management can actually implement. Okay, so scope is very important, and I will tell you that based upon things that I've observed and comments that I've had from other people, is that it's very important that we define the scope in such a way that we can get in and we can get out, we can report the results in a very, very timely manner. Okay, you notice the next piece is that we want to understand the auditee, including the auditee's objectives and assertions. Okay, so when we talk about assertions, we talk about this from the perspective of making sure that the things that management does, that management reports, the implied and explicit assertions related to these reporting is in fact reported appropriately. Okay, so again, if a department that we're working with reports numbers, okay, so they're reporting specific numbers, we are definitely going to be testing those numbers and making sure that this department is in fact reporting appropriately. Okay, very important point here, and we're going to be talking about this, is we want to identify key control activities. Well, what are key control activities? Well, these key control activities are the controls associated with key risks. Okay, so it's very important to understand that there's a relationship between risk and control, and as we're going through the audit, we're going to find a lot of controls, a lot of risks, but we want to make sure that we're focusing on the key things that become important. Okay? Evaluate the adequacy of the control design, create a test plan, develop the work program, allocate resources to the engagement. Okay, so these last items here really are sort of the functional area related to audit management and very critical to what it is that we're trying to do. Okay, performing is we're going to conduct testing. Okay, so conducting testing is very similar to what we do from the perspective of the external auditor, is we gather evidence, and we're gathering evidence in terms of related to the testing of assertions that we're doing. We reach conclusions, develop observations, and formulate recommendations. Okay, now this is why it's important that we actually define the scope in such a way that it is meaningful. And what I mean by this is that we ultimately want to communicate the results. Okay, so we want to communicate the results in a systematic approach. We want to communicate the results in such a way that they're meaningful both to management and then the communication that we have with the board of directors. Okay, so we perform the observations and evaluations and escalation process. And what we mean by this is that every level that we work through is we need to get the auditee to understand what it is that we see, and if in fact we're wrong, we want to make sure that we understand where we're wrong early so that we're not reporting inappropriate information to the board of directors. Okay? And what we're doing, we conduct interim and preliminary engagement communications. And what we mean by that is that as we are conducting the audit, is we are communicating on a preliminary and interim basis our results such that we're getting buy-in from management so that management understands what the issues are and we understand more about the organization or the process. Many times, as in the course of the audit, is I'll come back with management, I'll say, you know what, I'm really having a hard time understanding why you're doing this. And I may think that this is going to be a significant issue. And then as they walk through why they're doing it, is the light goes on and I say, oh, okay, well, I understand that. Okay, so that's not an issue, okay? So you need to understand that as we are communicating with management, we're doing this interim and in a preliminary way so that any minor issues can be resolved so that when we ultimately are reporting to the board, that these issues are reported in such a way that they are valid issues, and hopefully through our communication processes we've gotten buy-in from management and they understand what needs to be changed and what does not need to be changed. Okay? Next we'll go back here. And so final engagement, communication. So usually what happens in the communication process is we identify the accountable executive, in other words, the person that we're working with that is accountable for this from an executive position. We also have the key department head or the key department heads. So we are communicating on an interim basis with these key department heads. Once we've exhausted our communication, completed our testing, we clearly understand the process, this is then communicated to the accountable executive, and through this meeting with the accountable executive as well with the department heads is that we're able to develop a plan of correction. This plan of correction as well as our audit results are then communicated to the board of directors, and through this communication there is a strategy related to follow-up monitoring, and specific procedures that we're doing post-audit. Okay, so again, the communication absolutely critical, and we need to do this on a preliminary basis, on an interim basis. We need to figure out what our final results are that are going to be communicated to the key executives, the accountable executive, and within our communication with management and the accountable executive, that plus management plan of correction is then reported to the board of directors. Okay, so that's the communication process, and this is why it's so critical that we develop a scope of the audit that isn't so broad that this communication process goes on forever. Okay, so again, it's a reasonable assumption that we are planning this audit, say taking maybe 2 weeks to plan the audit, or maybe completing the audit in 2 or 3 weeks after that, and then this communication process is ongoing. But then let's say we have a week at the end of the audit where we're meeting with the accountable executive, and then we meet with the board of directors in their quarterly meeting or whatever. But it would be an efficient process for the chief audit executive to plan audits in such a way that we are coming in, doing the audit, getting out, and communicating in, let's say, a 4 to 6 week period. Okay, and the more people have talked about this, the more valuable it becomes in terms of having these very spot-on engagements. We address an issue, we go on. If, as we are going through this audit and we see additional items, well, we're not going to just ignore these, but what we're going to do is we're going to put these additional items on our audit program to come back and to extend the audit. Okay. Now, the only exception to this is if we start the audit and we identify things like fraud or material issues that need to be addressed immediately. Okay, so if that happens, certainly we stop the audit and we re-engage and figure out what we're going to do. But in the general course of the process, this is exactly what we're attempting to do. A specific audit with a specific scope and a very regimented process in terms of performing the audit and then communicating. Okay, all businesses have the same basic operation. We have money in the bank, we plan, we design, we produce or provide services, we market, we deliver, we bill, we collect, we do all these things. We have vendors, we have human resources, we have all of these things. So what we're interested in doing from an audit perspective is looking at these business processes from the perspective of how we sort of frame our audit scope or our audit plan. Okay, so what you see here, and unfortunately what you see here is a little bit small in terms of writing. Let me erase the drawings here, but this is actually on page 5-5. So it's the fifth page of the fifth chapter. Okay, so what are we talking about? Well, what we're talking about, and actually it's the same thing in relationship to external auditing, is we look at things from a business process perspective. Okay, so the key things that we look at is human resources. So what's human resources? Well, clearly we're talking about hiring and firing people. There's some very solid audits that we should be doing related to that. Termination, and certainly from an IT perspective, how we get people on and off the IT system, how we actually get people off payroll, absolutely critical to the organization. So we talk about human resources, we also want to talk about payroll. So how is payroll functioning? So an audit related to payroll, very important. Okay. We think about manage financial resources. So again, when we think about the risk management approach related to the organization, we certainly want to understand how the organization borrows money, where they're borrowing it from, are they using equity versus loans, how they're managing cash, how they're managing the financial resources within the organization. Is cash lying around? Petty cash, things like this become a part of financial resources that we certainly are very interested in. Okay. Information technology. We are actually going to be talking a great deal related to information technology. Why are we going to talk about information technology? Because this permeates the organization. One of the things that's absolutely critical that we need to understand is that the auditor isn't necessarily this IT geek that loves IT. Okay, so in fact, the best IT auditors are those that look at the IT process from an audit perspective in terms of efficiency and effectiveness. So we're looking at internal controls, we're looking at implementation, change control. There's some very, very specific things that become essentially the framework for managing information technology from a control perspective. We're going to be talking about that, and audit absolutely should be involved in this process. Managing physical resources, not only buildings and so forth, but even the fixed assets, anything specifically related to the organization becomes crucial. And again, think about it from this perspective. And it's critical that we sort of understand this process from the perspective that as management or as internal auditors, we're looking for more than just things that are impacting the financial statement. Okay? So we're looking for the effectiveness and the efficiency of the organization. So while the external auditor may not view a dirty room or an unpainted building or something like this as being material to the financial statements, it's very possible that these are exactly the kinds of things that we would be interested in, because these essentially drive maybe the effectiveness of the group that's actually working in the building, or drives the strategy of the organization and the effectiveness. So there's things that we would look at as internal auditors that wouldn't even really be on the radar specifically related to the external auditor. So we need to understand that our scope of operations from an internal audit perspective can in fact be very different as compared to the external auditors. Manage compliance with laws and regulations, absolutely. We absolutely need to be working with the compliance department, and in fact compliance and audit, generally speaking, are of the same group. Managing external relationships, certainly looking at vendor relationships, looking at external parties, looking at when we outsource, say we're outsourcing certain IT functions or payroll, whatever the case may be, is we are looking for how these relationships are managed. Okay, so then we think about things from the project perspective. Okay, so in the project perspective is a couple of things that we're looking for. Is we are understanding the project. So maybe the project is identifying assets. We develop sort of the scope of what we're attempting to do. We execute it, and then we may hand this off. When we talk about project development, we're going beyond the assessment, and in fact we're working at it from the perspective of a consultant. Okay, now, and again, consultant, nothing wrong with that, absolutely nothing wrong with that. We just need to make sure that as we are looking at these things from a consulting perspective, that we are not overstepping our bounds and then creating a scenario where that we would be actually auditing the things that we've actually changed. Okay, so there's a relationship there that we need to make sure that we maintain our independence. Okay, so the next page, on page 5-6, is what we're looking at is we're looking at the level of process depiction. Okay, so the issue becomes is as we are looking at a process, and here what we're looking at is the sales cycle, is we need to understand that the sales process can in fact be very simple. Say you're a grocery store, you're cash only, is you hand over the cash, we complete the transaction, and we're done with it. Or it could be highly complex. And these are the things that we need to understand. And as we are actually working through these processes is, and in fact what you see here are what we call flow charts. Okay, so when we talk about flow charts, is we need to understand that each of these squares is a process. Now, I've seen some auditors that get so wrapped up into this, and instead of having 4 or 5 boxes, is they break this down into 20 or 30 boxes. Well, maybe that's too much detail, but what we want to sort of consider is what are the key processes in terms of the process. Okay, so again, what are we looking at here is that we're looking at a sales process. So what are the intermediate steps related to the sales process? And the question becomes is, well, why is that important? And the answer is why that's important is because in this sales process, and in terms of this, whatever process we're looking at, is the process essentially defines where the internal controls should be. So as we're looking at this, is we need to have enough detail so that someone can actually come in and in the discussion is explain how controls come in in relationship to each of these control steps, each of these process steps. Okay, so a couple of things here is, again, this is a flow chart, and what you see, a couple of things, is what is this a flow chart of? This is a flow chart of coming to school, I believe. Okay, so a couple of highlights here is you notice that we have the oval. Okay, the oval is the beginning and the end. So the beginning is we start the process, we wake up, and the end is that we arrive at class. Okay, now as we've talked about, is the rectangles is processes. So we pack our bags, we set the alarm, we go to bed. Okay, and we sleep. Okay. And now we have a triangle. The triangle is a decision. Okay? So in the decision is, the question is, has the alarm gone off? No, then we continue sleeping. If yes, then what do? Well, we get up, and you notice that there is no decision part, decision item of did we set the snooze button. Okay, I don't think they call it the snooze button on the iPhone, but did we reset the alarm to sleep for another 10 minutes? Okay, and if that happens, then you could certainly add that as a decision. Okay, but in any event, what do? We get up, we get dressed, we get our backpack, and then the next decision tree is, and again, in the decision tree, as we're looking at things from a decision, a yes or no, or maybe is yes or yes one, yes two, and no. You could have multiple decisions from a decision tree, but in this case it's yes, no. So, or in this case it's drive versus bus. Okay, which is, again, perfectly acceptable. We just need to make sure that we understand what the decisions are in relationship to this process. Okay, so that's pretty easy. Continuing on here, what we see is if we drive to campus, we search for parking, we walk to class, and then the decision tree is, do we have time to get the coffee? Or it could be, do we have time or do we want coffee? If yes, we get coffee. If no, then we just go directly to class. Okay, and then you notice that each decision tree, each decision has a marker. So these markers are down here, A1, A2, A3, A4, A5, A6. Okay, so what you see here, kind of a simple, silly example, but it's actually a very good description of what we're going to do in terms of a control process. So we look at this and we say, okay, where are the controls that we need to have? Well, we clearly need to have a control related to the alarm. Why do we need a control related to the alarm? Well, the control related to the alarm is if the alarm doesn't go off, we're going to continue to sleep and everything goes bad. So we need to think about this from the perspective of what are the risks and what are the controls. But at the beginning, is all we're looking for is we're looking for a process and a descriptive process so that we can then, and this frankly would be something that we would go to management, and the conversation, and this would be one of the preliminary steps. The conversation would be is, this is my understanding of the process. Let's walk through it and make sure I understand exactly what's taking place in regards to what you're attempting to do to go to school on time every morning. Okay? And then that then becomes a very interesting discussion, because it actually helps the client, the department head, understand what we understand, and maybe what we understand is not exactly correct, but it also helps them understand how we're viewing the world and why we are actually looking at this from a control perspective. Okay, so that's actually kind of a fun little marker there. Okay, let's continue on here. We're actually, I think we're getting behind the clock here, so I want to focus on a couple of things. Okay, so again, when we look at the basic risk model, we are looking at strategic risk, compliance risk, and reporting risks. When we look at operational risk, we're looking at processes, people, and financial issues. Okay, I think we basically talked about that. Okay, whether it's internal or external audits, start with the client strategy. We continue to operations, and then to compliance, then to reporting. Notice that we always start with strategy, then operations. So again, what is the strategy of the organization? Is it a bank? Is it a fast food shop? Based upon strategy, what is the competitive advantage? Well, we need to understand this. What's the margin? What is the gross margin of our organization versus other organizations? We're going to understand the entity and its environment. We're not really talking about compliance right now, but what we're looking for is we're looking for people risk, we're looking for financial risk, so we're looking at it from a risk perspective. So we concentrate on operational risk, and certainly from the internal auditor's perspective is we absolutely are going to be looking at operational risks. So operational risk, and again, includes these business processes, such as receiving, purchasing, sales cycle, cash collection, whatever the case may be, is we look at them from a process perspective. Okay, we've talked about this in terms of the flow chart. The thing that we want to think about is, and I've mentioned this earlier, is we're going to look at things from a key risk perspective and from a secondary risk perspective. Okay, so a key risk perspective is what we're looking for is we're looking for something very specific in terms of the event. Okay, and secondary risks, in fact, could be secondary nature to what's taking place. And in fact, if you look what we're looking at here, I think I do have another screen here that I want to focus on, and this here, down here. Okay, so this is key risks as well as secondary. Okay, so we're looking at the process map, and we're looking at the process map related to, I guess this is a pizza place. Okay, so you notice that a risk is that, a key risk is that the order is written down incorrectly. So the risk is if you order pepperoni pizza when in fact they wanted mushrooms, that's a problem. Customer not told the ingredients are not available, so they order pepperoni. We agree to do pepperoni, but guess what? We don't have pepperoni. Okay, so that's a key risk. Order misunderstood by the pizza maker. Key risk. But you notice here is from a process customer collection perspective is customer, the ingredients are not available. Well, why are the ingredients not available? Well, from a customer perspective, that's a risk that we're going to lose the customer. But from a secondary perspective, the risk is that, the control is that we don't have a good ordering process. Okay, so we need to understand sort of how these pieces work together. Oven stops working. It's a key risk related to making the pizza. Secondary risk to delivering the pizza because we can't deliver the pizza if we haven't made it yet. And customer collection, secondary risk because, again, we can't collect the money if we haven't made the pizza yet. Okay, so you get the idea of key risk, the risk that is actually we are addressing in terms of the thing that could go wrong. And then the secondary risk is if this thing goes wrong, as an example, if the ingredients aren't there, that's a key risk. But from a customer perspective, we're not going to be able to collect the money. If the oven stops working, the key is that we're not going to make the pizza. But secondary to that, we're not going to be able to deliver the pizza, and we're not going to be able to collect any money from the customer. Okay, critical risks and the identification of critical risks. Now, the key point here, and again, we are rambling on here, so I'm going to jump over to Chapter 6 after this. Very important is what you notice here is we are using a risk map where we have impact on the side. So consider this the y-axis over here, the x-axis over here, and likelihood. So what we are looking at, and you notice how all these areas are red. Green, not so much concerned with. Yellow may in fact be something that we're concerned with. But from a risk perspective, we absolutely are interested in the items that have a high impact, if in fact they go wrong, and that they have a high likelihood. Now you notice that there's actually very few things related to impact and likelihood that are in the red areas, but from a risk perspective, these are absolutely the things that we need to start with as we are managing risks. Okay. Let's jump over to Chapter 6. And, okay, so we actually do have Chapter 6. Okay, so Chapter 6 begins our discussion related to the COSO model of internal controls. And we talked a little bit about COSO and internal controls. And like I said, I'm going to give you a presentation primarily from the external auditor's perspective, but certainly from the internal auditor, you need to be certainly aware of the internal process. Okay, so we talk about internal controls from a risk framework, of internal controls. Okay, so this framework of internal controls, we use the term CAMIRE, but we're talking about control activities, we're talking about the environment, we're talking about monitoring, and what we're looking at is we're looking at the framework where an organization is able to identify what can go wrong and from there be able to develop a control strategy. And this basically is the framework of the COSO model. In here we're using the CAMIRE framework, but this really is the COSO model. Okay, so the COSO model, you notice that this is COSO. For lack of better terms, we're going to consider this. Now, you notice, even though it's on the bottom, it's the most important. Okay, so the most important is the environment. So we want to make sure that we are actually developing an environment of internal controls within the organization. The risk assessment is next. As management is responsible for financial statements, they're also responsible for the internal control framework. As part of the internal control framework is they are required to complete an enterprise risk management assessment of internal controls and risks within the organization. Then we have activities, control activities, policies and procedures, and then finally, which is really the most minimal part of this, is monitoring. Included in this is information and technology. So you see here information and technology in the middle. Information and technology encompasses two basic concepts. The first concept related to information and technology is the fact that information and communication. Information and communication is the information infrastructure, the information systems infrastructure, but it's also the communication process within the organization. So we want to make sure that communication occurs in a very systematic way so that the organization is not relying on rumors and other things, but in fact information is communicated well into the organization. Okay? Environment, we're talking about ethical values, structure, independence of the internal audit group. So it's example, who does the chief audit executive report to? Well, hopefully he or she is reporting to the board of directors. The environment absolutely is driven by human resources. A strong human resource department is absolutely critical to make sure that we are hiring the right people and making sure that these people are actually brought on board appropriately and that they're not just hired because they're friends of a friend, but they actually have the legitimate right to be there because of their skill set. The risk assessment, we've talked about that in terms of an enterprise risk management assessment of the organization. What can go wrong? The control activities, policies and procedures, segregation of duties, running the computer systems, safeguarding assets, internal controls related to password protection on your computers, as an example, is a control activity. Information communication, we've talked about this. Monitoring, this is part of what internal audit does. But again, you go back to the table over here that we were looking at, and what you see is that monitoring is really a small part of the control environment. What's really driving this is what we call this tone at the top, or the ethical structure within the organization. So what we need to understand is the components of effective internal control, which is really this COSO framework. We need to understand the roles and responsibilities of each individual, senior management. Management is responsible for these internal controls, and in fact, the key component of this framework is that everybody is responsible. Nobody's allowed to say, oh, not my job. Not my job. I'm not going to do that. Okay, everybody's responsible. And there needs to be an awareness of the internal control process in the organization. Note that there's similarities and differences between the external and internal standards. Okay, the CPA, the external auditor, is assessing the risk of material misstatement. So the CPA is looking at the financial statements, and he or she is looking for, are there material misstatements in the financial statement? So they're looking at, is the reporting done correctly? The CIA is looking for process goals that are met. So as an example, the CPA is not really concerned with, are you doing a good job? They're only concerned with, does the financial statements fairly present the job that you're doing? The internal auditor is looking at the processes and what management is doing, and they're able to, and actually should be, asking the question, are you actually doing an appropriate job? CPA understands in the CIA test when the word is reviewing. So CIA, okay, so there is a difference in this process. We're not looking, as an internal auditor, we're not looking at the risk of material misstatement, but we clearly are looking at the effectiveness and efficiency of the organization. Smaller organizations have specific characteristics of control issues. Primarily, the issue is the fact that there's not enough people. One of the key control structures is this segregation of duties. Well, if you don't have enough people, you're not able to segregate the process. So when you look at smaller companies, there clearly needs to be an understanding of how these smaller companies work in such a way that they have what we're calling compensating controls related to the process. I'm not going to go through this, but when you see the presentation related to COSO that I'm going to send to you, is COSO actually, and this is something that you absolutely need to remember, has principles. This actually starts on page 69, principles related to the control environment, risk assessment, and so forth. So these principles, absolutely critical. Again, take a look at the presentation. Monitoring process, again, monitoring is what the internal auditor does, and we are establishing a foundation, designing and executing, and assessing and reporting, which basically we've talked about already. We need to understand that we can never eliminate risk, and in fact, risk is a part of business. If you eliminate risk altogether, the business is not going to survive. But we need to manage risk, and the key is managing the risk, and we need to understand how that risk, excessive or under-risking, creates unique problems to the organization. We talked about this, and this actually is the process that we're going through. The idea is that there will always be risk. Okay, so we never eliminate risk, we manage risk. So we need to understand what these residue risk is and how we're actually going to manage this. Risk assessment process, we've talked about this, the strategic, compliance, and reporting risk. And exactly at 9 o'clock, we are done. So that's all we can do tonight. So everyone have a great night, and we will talk to you later. Okay, bye-bye.